So here it is a question that is given to us that will be solving. And 1 USD to INR price is given. 2-month forward is given to be 45/35. And if the person A wants to remit the USD 10,000 after 2 months, what will be the cost to person A that we need to ascertain? Okay, so now the price that you are provided with, if the question is silent about it, I already told you it is a spot rate that is given. So I'm just writing it over here. So USD is equal to 76.10/30. This is the buying rate and this is the selling rate over here. And further, it is now given over here that if person A is to remit the USDs, if the person A is to remit the USDs, now I already told you, now the person A is basically an individual who wants to remit USDs. Now, if he wants to remit the USDs, he has to purchase the USDs first of all now. And at what price he will be able to buy the USDs? At the price at which the market is ready to sell. Okay, so he or she will be able to buy the USDs, 10,000 USDs at a price at which the market is ready to sell. So what rate shall be quoted? It will be the selling rate that shall be quoted. So we can simply say USD is equal to 76.30 over here. And further, we are over here provided with the 2-month forward rate. So the 2-month forward rates are given to be 45/35. So these are the buying points and these are the selling points. Now what is the scenario? The currency is available at discount or at premium. I already told you that if selling points are greater than buying points, the currency is available at premium, and if the selling points are lesser than that of the buying points, the currency is said to be available at discount. Now over here in this particular case, the currency is available at a discount. The currency is available at discount. Now when the currency is available at discount, the forward points are to be added up or to be subtracted. The forward points are to be subtracted. The forward points are to be subtracted. Now we will be subtracting what forward points? We will be subtracting the selling forward points. Now you need to understand this particular point. We are considering the selling rate now. So we will be adding or subtracting the selling points only. Okay. So over here 0.35 will be subtracted because the currency is available at discount. So that is the rate that shall be applicable. That is 75.95. That is 75.95. That is the rate that is applicable over there. Now in this particular scenario, now what is the cost? What it will cost to person over here? What will be the answer? It is 75.95 multiplied by 10,000. Multiplied by 10,000, so it is 759500. So that is the answer to this particular question over here. Is that clear? I hope that most of you have understood the concept related to it, that how we do discover the point in the case of the forward rates over there. And further, you must be looking at from the view of the merchant rate or the interbank market rate. Now, if it was not given in the question that A wants to remit the 10,000 USDs, simply you must have considered the buying rate over there. Okay, so that is basically related to it. Now let's move to the another question. It says Forex rate in Mumbai is given to be USD 1 at this particular rate. In UK, Euro 1 is given to be 1.05/1.10. An exporter wants to discount the export bill of Euro 10,000. How much amount will be given to the exporter in domestic currency? Now you are aware of the terms like export bill. Now what is export bill? He must have shipped the goods and has drawn the bill on the importer which he has got accepted. And further, now this is export bill that he is basically a rightful owner so as to receive this particular amount, but he has not received it so far. And the question is silent about that if there is any usance period or not. So we'll be considering it to be what? We'll be considering it to be a site bill. So E went to the bank over here, XYZ bank we are considering over here for our reference purposes, and we are just thinking that what price will be quoted by the bank to the customer over here. Now the rate for the forex rate for 1 USD for the INR, it is given to be 68.10/30, and further in UK 1 euro is given to be USD 1.05/1.110. Now what is the scenario over here? The bill is drawn in Euro 10,000. It's not in USD. You must be keeping that particular thing in mind. So it's in euro over here. So this is the bill which is in euro, that is Euro 10,000. And further it is now to be discounted. It is to be discounted. Now exporter wants to sell this bill to XYZ. In case euro, he wants to sell what? He wants to sell the euros. At what price he will be able to sell the euro? At a price at which the bank is ready to buy. At a price at which the bank is ready to buy, but there is no direct relation, there is no direct currency pair available for euro to INR. So we will be first of all discovering the euro to INR price, then we will be looking into. Okay, so it is 1 USD is equal to 68.10/30. Now what the person E will be doing, person E, it will be thinking from the customer perspective over here. He will be buying the USDs first of all. He will be buying the USDs first of all. Then he will be basically doing it. So what will be the scenario? That he wants to sell the euros. He wants to sell the euros. Now what will be the thinking process? That he will be selling the euros, and he must be selling the euros in USDs. So he will be selling the euros and further will be getting the USDs. And further he will be selling the USDs. And will be getting the INR. So this must be the thinking perspective from the customer point of view. Okay, because no direct rate is available. So customer will be thinking like that he will be selling the euros because he has euro bill with him. So he will be selling the euros and will be getting the USDs. Further, he will be selling the USDs and will be getting the INR. Okay, so that is the scenario. Now what is the euro to USD rate is given? It is given to be 1 euro is equal to 1.05/1.10. It's not visible over here. Let me write it over here. So we can say it is given to be 1 euro is equal to 1.05/1.10/1.10 USD over here. Okay, so he wants to sell the euros over there. He wants to sell the euros. At what rate he will be able to sell the euros? At a price at which the market is ready to buy. So what rate would be applicable? It will be 1.05 euro rate, USD rate would be applicable. So 1 euro is equal to 1.05 USD. Okay, so that is the rate which is applicable in this particular case. And further, once he has received the USDs, he will be selling the USDs. Now he will be able to sell the USDs at what price? At the price at which the market is ready to buy. Again, the buying price over here. So from here we can infer 1 USD equal to 68.10 INR. So that is the case over here. Now over here we are having USD in common, so we will be equating those. So we can rewrite this as 1 divided by 1.05 euro is equal to 1 USD, and further over here 1 USD. Now we will be equating these two. So this will be equal to actually euro divided by 1.05 is equal to 68.10 INR. Simply we will be cross multiplying it, and that will be the answer. So it will be 68.10 multiplied by 1.05, and that comes out to be 71.505. So here comes the answer, 71.505. Let me explain this to you again. So over here we are provided with the different rates, and the export bill was drawn, which is in euro 10,000. Now from the exporter point of view, you must be thinking that he wants to sell the euros and want to get the INR, but no direct currency pair is available. So what he'll be doing, he'll be selling the euros and will be getting the USDs, and then he'll be selling the USDs and then will be getting the INR. So we are provided with the currency pair for euro to INR, euro to ISD, that is 1.05/1.10. Now this is the buying rate and this is the selling rate. Now he wants to sell the USDs. He wants to sell the euros. At what price he will be able to sell the euros? At a price at which the market is ready to buy. He will be able to sell the euros at a price at which the market is ready to buy. So he can sell it for 1.05 USDs over there. That price we considered, and further he wants to sell the USDs now. Over here we have provided the currency pair relationship two-way quotation for USD to INR, that is buying rate, selling rate is given over there, and further he wants to sell the USDs. At what price he will be able to selling the USDs? At a price at which the market is ready to buy. Again it is 68.10. Now we just simply equated these two quotations over there, and that would be the answer, and there we come with the answer over there. Is that clear? Is that particular part clear over here? Okay. Now let's move further to the next question. So it says, when the exchange rate is fixed by the market demand and supply position, it is called direct rate, floating rate, indirect rate, or fixed rate. When the exchange rate is fixed by the market demand and supply position, it is called what rate? Direct rate is that particular rate in which foreign currency is having a fixed variable, but the home currency is having a variable position, that is a direct rate, and opposite of that is indirect rate, where home currency is fixed and foreign currency is variable, and floating rate is that particular rate which is basically changing its value. It is basically based upon the market demand and supply position. So option B over here is the right answer. Pooja Roy has given the answer correctly at the earliest. Option B is the right answer in this particular case. Option B over here is the right answer. Okay, question number 1, option B is the answer over here. Now, fixed rate is that particular rate in which the regulator fixes the foreign currency prices, and those are not considered as per the market scenario. Okay, so that is a fixed rate. Question number 2, it says if the spot rate is given to be 2, interest rate differential is given to be 4%, forward period is given to be 60 days, calculate the forward points by taking a year is equal to 360 days. So what will be the answer related to the question number 2? We need to calculate the forward points in this particular scenario. We need to calculate the forward points for this particular scenario. So spot rate is given, interest rate differential is given, forward period is given, and it's quite easier that we can do calculate it. So what is the answer? So what is the formula related to it? Let me just remind you again. So it is a spot rate multiplied by the interest rate differential multiplied by the forward period and divided by 100 and number of days in year. That is the formula. Spot rate is given to be 2, interest rate differential is given to be 4, forward period is given to be 60 days, divided by 100, number of days in a year to be considered to be 360. So that is the answer over here. So that is the answer over here that we need to calculate. It is 2 into 4 into 60 divided by 100 divided by 360. That is 0.013333. So Priyanka has answered correctly at the earliest. That is option C over here. And also Raji Ahmed has answered the very first instance. Option C is the right answer. Question number 2. Option C is the right answer. Is that clear? Okay. Let's move to the next question. It says, the delivery of funds take place on August 12, 2013 for the contract dated July 10, 2013. Which of the following rate of exchange will be used? Which of the following rate of exchange will be used? Ready or cash rate, term rate, spot rate, or forward rate? Which one would be the right answer? So which one would be the right answer? It is forward rate. It is a forward rate. So the right answer over here is option D, the forward rate, and Akshay has answered at the earliest. Option D is the right answer. That the forward rate it is. Okay. Let's move to the another question. It says, which of the following rate is used by the bank for purchase of a foreign currency demand draft from its customer? Which of the following rate is used by the bank for purchase of a foreign currency demand draft from its customer? If the bank wants to purchase the foreign currency demand draft, what rate shall be used? What rate shall be used? If you want to buy from the customer, what rate shall be used? What rate shall be quoted? Nothing, that way that the customer visited the bank XYZ and he wants to sell you the demand draft. In a way, he wants you to credit his account against the foreign currency, or we can say he wants to sell the foreign currency. You want to purchase a foreign currency demand draft from the customer. He wants to sell you the foreign currency. Now, what rate shall be quoted to the customer? It shall be the buying rate which will be quoted. It will be the buying rate which will be quoted to the customer. Are you getting this particular point? And further, there is no differences in between, because at the same time, at the same instance, the amount will be credited to the XYZ account over in case of the demand draft itself. So what shall be the answer? Would it be the buying rate or the TT selling rate or the TT buying rate? What will be the answer? It is option B over here. So Naina has answered correctly at the earliest, that is option B, that is TT buying rate is the right answer. That is TT buying rate is right answer. Let me clarify this to you again, that whensoever the rates are to be considered, you need to look into two factors. First of all, when the settlement is going to be happen and what rate shall be quoted from the bank point of view. Okay, and if you are certain these two, definitely you can answer it correctly. So if the customer just visited your branch and further he wants to sell the demand draft to you, in a way he's selling so as to, he wants to sell the foreign currency to you. He wants to sell the foreign currency to you. Now if he wants to sell the foreign currency, what rate shall be quoted? The buying rate shall be quoted, because the rate shall be quoted at which the bank is ready to buy. So it shall be the buying rate. Okay, and as such there is no difference, so it will be the TT buying rate which will be applicable for this particular transaction. So it will be the TT buying rate. Next question, it says 1 per milli represents which of the following? 1 per milli represents which of the following? One part in every 10, in every 1000, in every 100, or in every 1 lakh. It is one part in every 1000. So again, Priyanka has answered correctly at the earliest. Option C over here is the right answer. That is one part in every 1000. Option C is the right answer. Let's move to the next question. Question number 6, it says the selling rate for foreign currency offered by bank is called. The selling rate for foreign currency offered by bank to call bank is called what? Kindly please do mention question number along with it so that I can get it for what question you are answering. So it is an offer rate. So it is an offer rate at which the bank is ready to sell. Bid rate is the rate at which the bank is ready to buy, and the offer rate is the rate at which the bank is ready to sell. Next question says a binding contract for purchase or sale of foreign currency at a future date is called. So if there is a binding contract between the two parties that they will be buying or selling, they will be purchasing or selling the foreign currency in a future date, it is said to be what contract? It is said to be a forward contract, and forward contracts are derivatives. These forward contract is also a derivative. It is also a derivative. Now what is a derivative? Derivative is an asset which basically derives its value from the underlying asset. It does not have any value of its own, but it derives the value from the underlying asset. And what type of derivative it is? It is OTC, over the counter traded derivative. It is over the counter traded derivative. Okay, so option B over here is the right answer. Question number 7, option B is the right answer, and Naina has answered correctly at the earliest. Next question says if a bank is requested to transfer amount from NRE rupee account, non-resident external rupee account, to FCNR bank account, that is foreign currency non-resident bank account of a customer, which of the following rates shall be used? Which of the following rates shall be used? Bills buying rate, TT buying rate, bills selling rate, TT selling rate. What would be the answer? Try to understand the question itself first of all, and kindly please do answer at the earliest. So if a bank is requested to transfer amount from NRE rupee account, first of all you need to understand the denomination. Now the NRE rupee account is basically rupee denominated. It is rupee denominated. Now the customer wants actually what? He wants to buy the USDs. He wants to buy the foreign currency, not USDs particularly. He wants to buy the foreign currency, and further then want it to be credited to the FCNR bank account. Now over here in the NRE account, the amount is basically deposited in INR, and further he wants to buy USDs. Now if you want to buy the USD, at what price he will be able to buy? He will be able to buy the USDs at a price at which the bank is ready to offer, at the bank is ready to sell. That is the selling rate would be applicable. So the answer will be either be C or D. Either the answer will be C or D, and further the bank will be issuing the USDs at the same time. So there will be no settlement rate difference. So definitely it's not option C. So option D is the right answer. Option D is the right answer. So Akshay has answered correctly at the earliest. That is the TT selling rate would be applicable. Question number 9. Option D is the right answer. Question number 9. Option D is the right answer over here. Next question says, that is basically the part, which of the following department of the dealing room takes care of processing of deals, accounts, reconciliation. So there are three components, or we can say three departments in the dealing room itself. That is the front office, mid office, and back office. Now, which department of the dealing room take care of the processing of deals, accounts, reconciliation? So it's the back office that takes care of that same, and mid office is responsible for the risk management, all the things, and the front office is the main office, which is dealing particularly with the different counterparties. Option C over here is the right answer. Let's move further. Question number 11. It says spot rate is given to be USD 1.320010. 1 month forward, 2 month forward, 3 month forward rates are given. And 1 month forward USD can be purchased at what price? 1 month forward USD can be purchased at what price? Which of the following will be the right answer? Which of the following will be the right answer? Okay, so spot rate is given and simply the purchase rate is to be calculated. So you'll be considering what rate? The merchant rate or the interbank market rate? I just told you that when the question is silent about it, nothing is mentioned. We'll be considering what? We'll be considering the interbank market rate. Now the spot rate is €1 is equal to 1.3200/10. This is the buying rate and this is the selling rate. And in question it is clearly asked, we want to calculate the 1 month purchase rate. 1 month purchase rate means 1 month buying rate. So this particular rate will be considering. So this particular rate will be considering, and for the 1 month forward points are given to be what? These 1 month forward points are given to be 40/35. Now the currency is available at what? Selling points are lesser than that of the buying points. The currency is available at discount. The currency is available at discount. So it is 1.3200. And further we are to subtract the forward points. So it will be 0040 are to be subtracted. 0040 are to be subtracted. You just need to take care of that particular point only. Because we have to consider the buying rate, purchase rate. So these are the forward points related to buying rate only that we need to subtract. Okay, so it is 0.0040 that those are to be subtracted from here. So which one would be the right answer? So it is 1.3160. 1.3160. You need to take care about the merchant rate or the interbank market rate. Now nothing is mentioned over there in the question itself. You will be considering it to be the case of the interbank market rate. For interbank market rate, buying rate is a buying rate, selling rate is a selling rate. So it will be what? It will be the buying rate for the purchase. Okay, so it will be the buying rate which will be considering, that is 1.3200 and not 1.3210. Is that clear? So option C over here is a right answer. Question number 11. It is a option C over here, which is the answer, right answer over here. Now let's move to the question number 12. It says a foreign currency dealer maintains two types of positions which are as under. Now foreign currency dealer needs to maintain the two positions. Which are these two positions? This is related to the funds position and the currency positions. This is related to the funds position and the currency position that a foreign currency dealer has to maintain. So option C over here is the right answer. Option C over here is the right answer. That is fund position and currency position. And Pooja Roy has answered correctly at the earliest. Option C in question number 12 is the right answer. Let's move to the next question. It says, if foreign currency has already been received in Nostro account, payment is to be made in Indian rupee later. Which of the following rate will be used? If the foreign currency cover has already been received in the Nostro account payment and the payment is to be made in Indian rupee later, which of the following rate will be used? Now here is a scenario. If the Nostro account is already credited In that particular case, the customer want to sell. The customer want to sell the USDs now, or the foreign currency. Now, at what price the customer will be able to sell? At the price at which the bank is ready to buy. So, as the transaction has already been settled, so it will be the TT rate which will be applicable. And what rate shall be quoted by the bank? It is a buying rate that shall be quoted. So, what rate is applicable? It is a TT buying rate which is applicable. It is a TT buying rate which is applicable over here. So, what will be the answer? So, option B over here is the right answer. Option B over here is the right answer. Kindly please do mention the question numbers along with it so that I could identify. So I'll be keeping as that the Shreyans has answered correctly at the earliest. Option B, that is a TT buying rate, is the right answer. That is a TT buying rate is the right answer in this particular case. Okay, further it says USD is available in Delhi at 1 USD is equal to 76.10 USD. A USD rate in London is 1 USD is equal to 1.10 euro. What will be the euro to rupee rate? What will be the euro to rupee rate? So it's a simple case of the chain rule. Simple case of the chain rule. So kindly please do answer at the earliest and at the earliest over here. So 1 USD is equal to 76.10. So simply to equate the USDs over here. So 1 USD is equal to 76.10 and for the 1 USD is equal to 1.10 euro. Here it is INR, over here it is euro. Simply we'll be equating these two. So we can simply say 76.10 INR is equal to 1.10 euro, or euro to INR rate we were to calculate. So it is euro to INR over here is equal to 76.10 divided by 1.10 divided by 1.10. So that will be the answer over here. So that will be the answer over here. So what would be the answer? It is 76.1 divided by 1.1, that is equal to 69.18. So none of the above. That option D over here is the right answer. Option D over here is the right answer. So Nisha Vasti has answered correctly at the earliest. Question number 14, option D is the right answer. So that would be all related to this particular unit related to foreign exchange that we have covered so far. Let me change the file over here so that we could learn the concepts related to the Basel 3.2. So the Basel Accords are there. The Basel Accords are there. Let me just give you a brief history related to that, what is actually the Basel Accord related with it. Okay. So Basel Committee on Banking Supervision. Actually, it was a group of 10 which basically united over there, and at the end of 1974, the BCBS was formed. The BCBS was formed under the BIS, that is the Bank for International Settlement. Okay. So under the BIS, BCBS was formed. And further, under the BCBS, the guidelines are issued. The guidelines are issued because they know that there are inherent risks which are available in the financial market itself. And those all risks must be ascertained, and further, the capital must be maintained against all those risks. Now, in the banking sector itself, in each and every step over there, the risk is available, whether it is a risk related to the settlement risk, whether it is related to the currency risk, whether it is a market risk, interest rate risk, credit risk, operational risk. So all these risks are already there. But Basel is importantly concerned about three main risk type, that is a credit risk, market risk, and the operational risk. So the Basel I Accord basically was covering before only two types of the risk, that is related to the credit risk, and the market risk was further added to it in 1996. RBI implemented, you need to memorize these things, RBI implemented Basel I Accords in India in 1992. So these were implemented, these guidelines were implemented, Basel I Accords were implemented in India in 1992, and further the amendment was there so as to include the market risk. Previously they were maintaining the capital only and only for the credit risk, but as per the new amendment to the Basel I Accords, the credit risk market capital is also maintained, and also the capital is maintained for the market risk. And further there were amendments under Basel II, and then there is capital is also being maintained for the operational risk also. And there are three pillars in case of Basel. There are three pillars in case of Basel. What are these three pillars? First pillar, it is the minimum capital requirement. First pillar, it is related to the minimum capital requirement. That is a capital adequacy ratio we are dealing with in the first capital over there, that for the different risk that is related to the credit risk, market risk, operational risk, we need to maintain the minimum capital that is basically prescribed by the regulator. That is prescribed by the regulator over there. Okay, and the second pillar, it is a supervisory review process. It is basically consisting of two components. One, it is a SREP, supervisory review and evaluation process, and the other one, it is a ICAAP. So there are two components in case of SRP. One, it is a ICAAP, internal capital adequacy and assessment process, and the second one, it is a SREP, that is supervisory review and evaluation process. ICAAP is related to that whatsoever risks which are not covered under the pillar 1, those all must be ascertained and the capital must be maintained against them also. That is a bank's internal process. That is a bank's internal process. But SREP is basically related to that the regulator will be supervising it. That the regulator will be supervising it if the instructions are being followed by the banks or not. Okay. And further, the third pillar, it is related to market discipline, that basically supports these two pillars. That is basically related to the transparency. How we can basically be disciplined in the market itself? By having the transparency, by related that what is our CRAR, what are our different risks we are dealing in. Okay, so that is related to transparency with it. Okay. So first of all, we will be covering related to pillar 1, that is a minimum capital requirement. So there are different approaches by virtue of which we do calculate the capital charge for the credit risk. So there are three approaches for the credit risk. It is a standardized approach, IRB foundation approach, and IRB advanced approach. So standardized approach is an approach in which Reserve Bank of India basically gives the risk weight assets for the different categories of the assets being maintained by the bank. So let me give an example. Let us take the case of the credit card, where the bank's portfolio is having the credit card outstanding amount of rupees 1 crore. Okay. Now the risk weight asset as prescribed by the Reserve Bank of India under the standardized approach, it is 125%. It is a 125%. Now for 125%, how much risk weight assets these are? Actual outstanding amount for credit card, it is 1 crore. But as per the risk weight asset, it will be amounting 1.25 crore. It is amounting 1.25 crore. Okay. Now the capital is to be maintained for the against the risk weight assets and not for the outstanding amounts. The banks need to maintain the capital against the risk weight asset amount and not against the outstanding amount. Are you getting this particular point? So the risk weight asset is basically related to how much risk weight is there against this particular asset. That is the percentage that is given by the Reserve Bank of India under the standardized approach over there. Now credit card, it is 125%, so it is 1.25 crore against which the capital is to be maintained. So there are three approaches in the case of the credit risk. And for the market risk also, there are three different approaches, like standardized approach, maturity and duration, then the internal models method, and also for the capital for operational risk, there is BIA, that is basic indicator approach, standardized approach, and advanced measurement approach. Okay, so we will be covering the different guidelines over here related to it. First of all, we will be covering the pillar 1. So Basel I Accords in 1996 amendment take into account the capital requirement for the credit risk and the market risk. The operational risk was not yet added to the Basel I Accords, but was added in the Basel II Accords. That was related to that it was basically covering all the three risks over there, that is credit risk, market risk, and the operational risk. And for the BCBS guidelines are advisory to the regulators. These are what? These are advisory to the regulators. These are not mandatory guidelines. And further, these are the minimum standards which are to be followed. By the banks over there. So if the BCBS has prescribed, let me just give you a hint over there. If the BCBS prescribed that the CRAR, that is a capital risk weight asset ratio, or CAR, that is capital adequacy ratio, is to be maintained at 8%. It is to be maintained at 8%. But the Reserve Bank of India has prescribed that the CRAR or CAR is to be maintained at 9%. Okay, so BCBS guidelines are the minimum standards which are to be implemented, and further the regulators, that the central banks of the countries, they can further set up the higher standards too. That is as per their directives. Okay. Now let us consider the capital charge for the credit risk. I already told you that there are two approaches for that particular purpose. That is the standardized approach and the internal rating based approach, which is further divided into two categories. That is the foundation internal rating based approach and the advanced internal rating based approach. Now let's consider the components of the regulatory capital. First of all, we must be considering the components of the regulatory capital, that those are to be maintained. So there are two components in the capital itself. That is a tier 1 capital and the tier 2 capital. The tier 1 capital is a core capital. The tier 1 capital is said to be what? It is said to be the core capital that is to be maintained, and it is also said to be the going concern capital. That is going concern capital. It is actually the liquidity which is available with us. It is actually related to the liquidity which is available with us. That is the most liquid capital it is. Okay. And it is further having two components. That is the CET1 and the AT1. CET1 is common equity tier 1 capital and AT1 is additional tier 1 capital. And tier 2 capital is basically said to be what? It is said to be gone concern capital. It is said to be gone concern capital. And this is basically CAR that we calculate. This is basically the CAR that we calculate against the risk weight assets. And further, other than these two capitals, the banks are also to maintain the CCB, that is capital conservation buffer, triple CB, that is counter cyclical capital buffer, that is to be maintained. Okay, that we will also be considering. First of all, let us have a look at the components so prescribed by the BCBS and the Reserve Bank of India. So as per the BCBS, the minimum CET1 prescribed is 4.5%. I'm just emphasizing it more over here. That is, this is the minimum percentage of the common equity tier 1 ratio that is to be maintained. This is a minimum percentage and not the maximum one. Okay, so minimally the 4.5% is to be maintained, but as per the Indian regulator, it is mentioned, it is basically prescribed to be 5.5%. Additional tier 1, it is 1.5% in each case, and for the total tier 1, as per the BCBS, it comes out to be 6%, but as per the Indian regulator, Reserve Bank of India, it is a 7%. Now this point is quite important from the numerical point of view, from the case study point of view, because if it is mentioned in the question that if it is an international bank, in that case you'll be considering as per the BCBS standards. But if it is mentioned to be as per the RBI directives or an Indian bank, in that case you'll be considering this particular section. Okay, so the total tier 1 that is to be maintained, that is 6%, and further as per Indian regulator, it is 7%. The tier 2 is to be maintained at 2%. And this is the maximum percentage for the tier 2. It is 2%, and further the minimum capital required, the minimum total capital required, it is 8% as per the BCBS and 9% as per the Indian regulator that I already just conveyed you. And further, it is a CCB, that is a capital conservation buffer to be maintained. Now in the good times, when you're basically everything is working fine and everything is very much going smoothly, in that particular case you need to maintain an extra capital so as to basically overcome the stress situations. So that is said to be what? That is basically the CCB, that is a capital conservation buffer, and it is also maintained in the form of CET1 capital. So whatsoever the components over there in the CET1 capital, those components are to be maintained also in the form of the CCB over there, and it is to be maintained at 2.5%. It is to be maintained at 2.5%. So the minimum CET1 and CCB, it is 7%. It is basically minimum CET1 and CCB, it is 7%, because 4.5 plus 2.5, it is 7%. And in India, it is 5.5 plus 2.5, that is 8%. And the total capital plus CCB, it will be 8% plus 2.5, that is 10.5, 9% plus 2.5, that is 11.5%. Okay. So one thing that you must be understanding, that the capital is divided into two parts. One, it is a tier 1, and further it is a tier 2. And further it is a tier 2. Tier 1 is further divided into CET1, and further it is divided into AT1, and tier 2 is as such. The tier 1, the CET1 India, I'm just considering about India over here. So CET1, it is to be maintained at 5.5%, additional tier 1 at 1.5%, tier 2 at 2%. So in total it is to be maintained at 9%. Other than that, the banks are also to maintain the CCB, that is a capital conservation buffer, is also to be maintained over there. So that is related to it. Okay. Now let's move further. So how we can calculate the CET1 capital ratio? If in question we are asked that we need to calculate the capital ratio, CET1 capital ratio, how we will be calculating? It will be the CET1 capital that you are having. It is basically the CET1 capital you are having. Just look at the formula over here. Okay, so it is a CET1 capital you are having divided by the total risk-weighted assets. Total risk-weighted assets and further multiplied by 100. That is how you will be calculating the percentage. And if you have to calculate the total capital, if you have to calculate the CRAR, in that case, you will be basically adding up the tier 1 capital, tier 1 plus tier 2 capital divided by the total risk-weighted assets, divided by the total risk-weighted assets multiplied by 100. That will be the answer over here. That will be the formula that we will be using so as to calculate it. We'll be also be solving a case study based upon that, so you can understand the concepts well. Okay. So now let's have a look at the components of the CET1. So we are first of all looking at the components of the tier 1. I already told you that there are two capitals basically in tier 1 capital, that is CET1 and the additional tier 1. So first of all, let us consider the components of the CET1 capital over there. Now CET1 capital is basically said to be what? It is said to be the tier 1 capital is said to be what? It is said to be the going concern capital or the core capital. And CET1 capital is a permanent capital and also it is a liquidable capital. So paid up equity capital is a component of CET1. Statutory reserves, other disclosed free reserves, capital reserves, which are representing surplus arising out of the sales proceeds of the assets. That is also what? Also CET1 component. Other than that, the stock surplus from the issue of common share. When the shares are being issued, let us say the case that the face value of the share was rupees 100 and further now the market value of the share is 153. Now 100 is the face value and the surplus, that is 53, is representing what? It is representing the share premium. It is representing the share premium. Now share premium is also basically component of what? It is basically also component of CET1 capital over there. Okay. And let me tell you that different types of shares can be issued. It can be the PCPS, it can be the RCPS, PNCPS. Now what these actually are, I'll be just letting you know about it. Okay. Other than that, the balances in the profit loss account at the end of the previous financial year. So in the previous financial year, whatsoever the balance was there under the profit and loss account, that can also be considered the component of the CET1. And further, the current year profits can also be reckoned on quarterly basis. So current year profits can also be considered as CET1 component, but you need to take one particular thing in mind, that the incremental provision for the NPA should not be deviated more than 25%. Should not be more than 25%. So let me tell you a scenario that if the let me take the case that when the Q1 you were having the profit of rupees 1 crore and further the NPA provision that you created was 10 lakh rupees. It was 10 lakh rupees. And in quarter 2 the profits are 2 crore rupees and further the NPA provision grew up to 12 lakh rupees. Now in this case the incremental deviation in NPA provision is what? It is 20%. If it has been more than 25%, if it has exceeded 25%, in that particular case you cannot consider the current year profit to be as component of the CET1. Otherwise you can. Okay, so that is basically this point. And further the 8.8 says revaluation reserves. Now it's quite important. Revaluation reserves were previously component of tier 2 capital, but now these are considered to be component of tier 1 capital, but these are to be considered at 55% discount. These are to be considered at 55% discount. Now what do you mean by revaluation reserves? Let us take the case that you purchased an asset in 1990 for 2 crore rupees. You purchased an asset in 1990 at 2 crore rupees, but now when you revalued it, it is valuing 20 crore rupees. It is valuing 20 crore rupees. Now revaluation reserve will be equal to what? Revaluation value basically exceeded by 18 crore rupees. Now this particular value, that is a 18 crore of the revaluation reserves which are basically existing. Now these can be taken as a component of the CET1, but the 18 crore value will not be considered. The value will be discarded, will be basically considered at a discount of 55%. That is only 45% of the value will be considered. That is only 45% of the 18 crore value will be considered to be as tier 1 capital. So 18 into 45%, that is equal to 8.1 crore value will be considered. 8.1 crore value will be considered as a tier 1 capital over there. Is that particular part clear over here? Other than that, foreign currency translation reserves. The foreign currency translation reserves are also to be considered, but at 25% discount. Now, what is foreign currency translation reserves? Now, when I just acquired an asset, let us say the case I made an investment. Being a bank, I made an investment in the foreign currency, and that was valuing 10,000 USDs. That was valuing 10,000 USDs. And at that particular instance, when I just invested the amount, the value of the USD was 72.30. It was 72.30. But now when I am translating this to my in my balance statement over here, balance sheet over there, in that particular case, now today value of the USD is 76.50. 76.50. Now I purchased at 72.30, but now it is 76.50. Now the difference between these two will be basically amounting to the foreign currency translation reserve. It will be amounting to foreign currency translation reserve. Those can also be reckoned on as C81 Capital, but at 25% discount. Other than that, deferred tax asset DTAs can also be considered as component of the C81 Capital. Is that particular part clear over here? Okay. Now let's consider the components of the additional tier 1. Additional tier 1. So PNCPS, that is perpetual non-cumulative preference shares. Perpetual non-cumulative preference shares. Now preference shares are basically related to those shares where the shareholder will be getting the preference so as to receive the dividend. And what do you mean by non-cumulative? Non-cumulative means if for one particular year the dividend was not declared. Let us take the case that 2018 dividend was not declared, 2019 it was not declared, in 2020 it was declared, and further if it is cumulative, if it has been cumulative, even if the dividend has not been declared, it must have been added up and will be paid as an arrear in 2020. But in the case of the non-cumulative, what does it indicate? That it will not be cumulate. It will not cumulate, and only the dividend for the current year will be paid. Okay, so that is related to non-cumulative. Perpetual means what? Perpetual means that the dividend will be paid for lifetime. Dividend will be paid for a lifetime. So that is basically the definition related to PNCPS. I already told you that different type of shares are issued like a PNCPS, PCPS, RCPS. Now PNCPS is related to what? PNCPS is related to perpetual non-cumulative preference shares. These are taken as a component of the AT1, that is additional tier 1. And further, if there is any share premium related to PNCPS, that is also to be considered as additional tier 1. Other than that, it is a debt capital instruments. Other than that, it is a debt capital instrument which are considered to be as component of the additional tier 1. Which are to be considered as a component of the additional tier 1 capital over there. And further, amount of PNCPS along with the PDIs, that is a perpetual debt instruments, is restricted to 1.5% of the risk weighted assets. Okay, so in total, these are basically restricted to what? These are restricted to 1.5%, because additional tier 1 is maximum, it can be 1.5%. Additional tier 1, it can be maximum at 1.5%. If we consider the CET1, it is a minimum prescribed capital. It is a minimum prescribed capital that is to be maintained. But for the additional tier 1, it is a maximum to 1.5%. So it is basically 1.5% only that is to be maintained. And if there is any surplus of PNCPS and the debt instruments, that is basically to be considered to be in the tier 2 capital. That will be basically considered as a part of the tier 2 capital. Are you getting this point over here? So these are the components of the additional tier 1. Further, it is related to components of the tier 2 capital. Further, it is related to the components of the tier 2 capital over here. So related to general provisions, loss reserves, these can be taken as basically taken as a part of the tier 2 capital, but these are restricted to maximum of 1.25% of the risk weighted assets. These are restricted to 1.25% of the risk weighted assets. Other than that, the debt capital instruments can be taken as a part of the debt of the tier 2 capital. And for the PDIs, if there is any of the debt instruments that is a PDI, in that particular case, PCPS, if it is, that is a PCPS, RCPS, that is a perpetual cumulative preference shares, RCPS, that is RNCPS, that is redeemable non-cumulative preference shares. Redeemable means those shares which can be redeemed, which can be basically converted into the debt itself. So it will be basically redeemable non-cumulative preference shares, redeemable cumulative preference shares issued by the bank. So those will be forming the components of the tier 2 capital. And other than that, it is a stock surplus arising from these particular share types. If it is issued, those will also form the part of the tier 2 capital. And further, I already told you that PDI can be issued in Forex up to 25% of the total amount issued. So if the total amount issued, debt instrument is basically what? When the company is to raise the capital, it can either be issuing the equity, or these can also issue the bonds and debentures. It can also issue the bonds and debentures. That is a debt instruments. That is said to be debt instruments. And perpetual debt instruments means what? Perpetual debt instruments means those instruments on which the company will be paying the coupon for a lifetime. Okay, so PDI can be issued in Forex too. up to 25% of the total amount issued. If the total PDIs are issued amounting rupees 10 crore, in that case, PDIs can also be issued in 2.5 crore value. Okay. And minimum maturity period is 10 years without any put option. Okay. Without any put option. And let me tell you a very important scenario related to it. That is related to the residual maturity. So if the residual maturity, I'm just writing it over here. In the case of the PDI, if the residual maturity of the bond is greater than 5 years, then 100% of the value is to be considered as a tier 2 capital. 100% of the value will be considered as a tier 2 capital. But if it is lesser than 5 years, if the residual maturity is lesser than 5 years, and up to 4 years, then in that case 80% of the value will be considered. That the value will be considered at 20% discount. Okay. And further, if the residual maturity of the debt instrument, is basically lesser than 4 years and up to 3 years, in that case 60% of the value will be considered. 60% of the value will be considered as tier 2 capital. And further, if the residual maturity is lesser than 3 years and up to 2 years, in that case 40% of the value will be considered. In case if it is basically lesser than 2 years up to 1 year, in that case 20% of the value will be considered. And in case if the residual maturity is lesser than 1 year, in that case 0% value will be considered. 0% value will be considered under the tier 2 capital. Okay, so that point, particular table that you need to understand, that if the residual maturity, minimum maturity of the PDI must be 10 years, and further if the residual maturity is greater than 5 years, in that case 100% of the part will be considered to be as tier 2 capital. If it is lesser than 5 years up to 4 years, then 80%, lesser than 4 years up to 3 years 60%, lesser than 3 years up to 2 years 40%, lesser than 2 years 1 year it is 20%, and if it is residual maturity is lesser than 1 year, then 0% will be considered as a tier 2 capital over there. Okay. Further, as I already told you, the tier 1 capital is known as the core capital, and it is the most permanent and readily available capital over there. Tier 2 capital elements, basically these are less permanent in nature, and tier 2 capital at no point should be more than 50% of the total capital. If the total capital we are maintaining it is 100 crore, the tier 2 capital must not be exceeding 50 crore value, and tier 2 capital at no point should be more than 100% of the tier 1 capital. Should not be more than 100% of tier 1 capital. So these are the restrictions related to it. So let us solve a question based upon that. So here is a case study we are having. So it is a case study based upon the capital requirement. So it says we are provided with the different components like authorized capital, paid up capital, statutory reserves, PNCPS, PNCPS component, share premium, debt capital instruments is given over there, general provisions and loss reserves, revaluation reserves are given, and total risk weight assets are given to us. Okay, so these are the different components provided to us, and we need to calculate the CET1. As per the first question, we need to calculate the CET1. Okay, first of all, let us bifurcate the components over here. So authorized capital, let me just number them first of all. That is 1, 2. Okay, so authorized capital is related to what? It is related to tier 1 capital. Paid up capital is also basically related to tier 1 capital. Statutory reserves are also part of what? Tier 1 capital. Is authorized capital part of? No, this is actually not. Paid up capital is part of this. Authorized capital is the maximum capital which can be issued by the bank itself. So it is not part of. I just understood it wrong. So authorized capital is not part of any capital actually. So paid up capital is part of tier 1 capital. Statutory reserves are part of tier 1 capital. PNCPS, it is basically part of what capital? PNCPS is part of what capital? It is part of additional tier 1 capital. If you memorize additional tier 1 capital, the premium on PNCPS is also one component of additional tier 1 capital. Debt capital instruments for tier 2 capital. Debt capital instruments for tier 2 capital with the residual maturity of 3 years and 6 months. I just told you that if the residual maturity is greater than 5 years, then 100% value is to be considered, and if it is lesser than 5 years or lesser than 5 years, and further up to 4 years, 80% value is to be considered. And if it is lesser than 4 years and further up to 3 years, 60% of the value to be considered. Now in this case, the debt capital instrument is basically having maturity 3 years and 6 months, that is greater than 3 years but lesser than 4 years. So 60% value is to be considered. 60% value is to be considered. Further, general provisions and loss reserves. So it is basically part of tier 2 capital over here. General provisions and loss reserves, these are also component related to tier 2 capital. Revaluation reserves are related to what capital over here? Revaluation reserves are related to the tier 1 capital. Previously, these were component of tier 2 capital, but now these are considered to be as tier 1 capital over here. Now we need to calculate the CET1 capital first of all. We need to calculate the CET1 capital over here. Now the different components related to CET1 capital. Paid up capital is related to CET1. Statutory reserves are related to CET1. Now these two components are related to CET1, and also the revaluation reserves are related to CET1 over here. Okay. So paid up capital for previous year, it is given to be, I'm just writing the components over here so that you can understand it well. So it is a paid up capital which is to be considered. Further, it is a statutory reserves. It is a statutory reserves. And the third one, it is a revaluation reserves. Third one is a revaluation reserves which are to be considered, but kindly keep in mind these are to be considered at 55% discount. Okay, so the paid up capital, it is 3000 plus the statutory reserves, it is 2250 plus the revaluation reserves are given to be 2500. 2500 at 55% discount means we will be considering only 45% of the value. So that would be the answer related to it. So CET1, we need to calculate the CET1 capital. So it is 2500 into 45%, that is 1125 plus 2250 plus 3000. So that is 5250. So I'm just mentioning it over here so that we can use it for further reference. So CET1 we just calculated at 5250. Okay. Next question is that we need to calculate the additional tier 1 capital. So the next question, it says we need to calculate the CET1 ratio, not the additional tier 1. The next question says we need to calculate the additional tier 1 over here. We need to calculate the CET1 capital ratio. CET1 capital ratio is to be calculated. Now the CET1 capital we calculated it to be 5250. We calculated it to be 5. I think I just made some mistake related to it. Let me check over here. Related to CET1, one answer we have received related to 6375. Let me check. So it is 3000. Yes, definitely. Actually, I just haven't added the 1125 component over here. So it will be 6375. Definitely, because 3000 plus 2250, it is 5250 plus 1125, that is 6375. It will be 6375. CET1 would be. So it is actually 6375, not 5250. So what will be the CET1 capital percentage? CET1 capital ratio. When we have to calculate the capital ratio, it is the capital that we have calculated, that is 6375, divided by the total risk-weighted assets. Now the total risk-weighted assets are 90,000. These are mentioned over here. These are given to be 90,000 multiplied by 100. That will be the answer, 6375 divided by 90,000, and further multiplied by 100. So that comes out to be 7.08%. It is 7.08%. Okay. So that is the answer related to the question number 2 over here. Now let's move further to the third question. It says we need to calculate the additional tier 1 capital. We need to calculate the additional tier 1 capital. Question number 3 over here, it says we need to calculate the additional tier 1 capital. Now the different component to additional tier 1, it is PNCPS and it is premium in PNCPS. These are two components related to additional tier 1 over here. So it is PNCPS plus share premium for the PNCPS. That is also component of additional tier 1. So PNCPS, it is 2000, and further share premium for the PNCPS, it is 200. That is 2200. So additional tier 1, it would be 2200. Would that be right answer? Because I just told you that it must be restricted maximum to 1.5% of the total risk-weighted assets. 1.5% of the total risk-weighted assets. What are the total risk-weighted assets? It is 90,000. So 90,000 into 1.5%. that is equal to 1350. So additional tier 1, it is restricted to 1350. It is restricted to 1350. I'm just writing over here. Additional tier 1 answer would be 1350 because it is to be restricted to 1.5% maximum. And what is the surplus we are getting? What is the surplus we are getting? Because we are having 2200 as the total components of it. So it is 2200 minus 1350. So this is a surplus which is available, and that will form a part of the tier 2 capital. I'm writing over here. That is a surplus to be 850 over here, which can be part of the tier 2 capital. Now we need to calculate the additional tier 1 ratio. What is the additional tier 1 ratio? Next question says we need to calculate the additional tier 1 ratio. What it would be? It is 1.5%. Directly we can say, because we need to maintain maximum, it had to be 1.5%. So we basically had a surplus over here. So it is 1.5% directly. What is additional tier 1 ratio? It is additional tier 1 capital. That is 1350 divided by 90,000. So it is 1.5% because we already restricted it to 1.5%. Okay. Next question, it says we need to calculate the tier 1 capital ratio. What is a tier 1 capital ratio? What is a tier 1 capital ratio? It is equal to C81, that is 6375, plus additional tier 1, that is 1350, divided by 90,000 multiplied by 100. So that is basically tier 1 capital, that is 6375 plus 1350 divided by 90,000, that is equal to 8.58%. 8.58%. So the tier 1 we calculated to be 8.58%. Okay. Further, next question says that we need to calculate the tier 2 capital. We need to calculate the tier 2 capital. Now, what are the different components related to tier 2 capital? First of all, it is a surplus that we need to consider. Surplus that you are having from the additional tier 1. Surplus plus the different components are general provisions and reserves. So it is the general provisions and reserves to be considered, but these are limited to 1.25%. 1.25% of risk-weighted assets. These are restricted to 1.25% of the total risk-weighted assets. I already told you that general provisions and reserves are restricted to 1.25% of the risk-weighted assets, total risk-weighted assets, plus the debt instrument. Plus the debt capital instrument. I'm writing DCI over here. And what percentage value to be considered? Only 60% value to be considered, because the residual maturity is greater than 3 years but lesser than 4 years. So it will be 60% values to be considered. So the surplus, basically we just calculated over here. It is 850. General provisions and reserves, it is mentioned to be 1600. It is mentioned to be 1600 but restricted to 1.25% of the risk-weighted asset. So 90,000 into 1.25%, that comes out to be 1125. So out of 1600, only 1125 part can be considered as tier 2 capital. Plus it is DCI 60% value. So it is DCI value is given to be 800 multiplied by 60%. Answer would be equal to 800 into 60%, that is 480. 480 plus 1125 plus 850. So that is actually equal to 2455. That is actually equal to 2455. Now, what were the restrictions related to the tier 2 capital? What were the restrictions related to tier 2 capital? First restriction, it was that at any instance, it should not be more than 50% of the total capital. Now, the total capital is basically it's not more than 50% now. So that is basically true. That is basically surpassed. And further, the second restriction was related to that at any particular time, it should not be more than 100% of the tier 1 capital. Tier 1 capital is basically greater than this particular ratio. So that is also surpassed. So we can consider 2455 as a tier 2 capital. So I'm just writing it over here that tier 2 capital, we just calculated it to be 2455 over here. Now, what is a tier 2 ratio? What is a tier 2 ratio over here? It is 2455 divided by 90,000. That is 2.72%. That is 2.72%. And what is CRAR for the bank? What is CRAR for the bank? What is CRAR, capital risk weight asset ratio, or capital adequacy ratio? One and the same thing. So it is a tier 1 capital plus tier 2 capital. Tier 1 capital is basically equal to C81 plus 81, that is 6375 plus 1350, and plus tier 2 capital is basically 2455 that we calculated, divided by 90,000 multiplied by 100. Okay, so that is a CRAR. That is basically That is basically 6375 plus 1350 plus 2455 divided by 90,000 multiplied by 100. So that is a percentage over here. That is a percentage over here. That is 11.311%. Is that particular part clear over here? And that is all related to this particular case study. That is all related to this particular case study. So you must be sticking to basics only. You must be learning the different components, that what these components are, what are the different percentages related to it, what component goes where, and that is how you can simply solve the questions related to it. So in India, it is regulated by the way of a FEMA, that is Foreign Exchange Management Act 1999, and Reserve Bank of India has been empowered so as to maintain the external value of the rupee and also to regulate all the foreign currency related issues and all the things over there. Okay, so why foreign exchange is important from the exam point of view? Because let me tell you that module A and module B itself are very much important, and module A is all about foreign exchange, that is related to international banking. So we will be covering the different methodologies, that how we can calculate the different rates over there, what is premium, what is discount, and all the concepts related to it. So first of all, we will be learning related to the exchange rate mechanism. It is related to the exchange rate mechanism. So let me let me give you a quick guide related to it. So we are having the ready rate or cash rate. Let us say the case that here we are having the person A and person B, and person A is going to be in a transaction with person B. Let us take the case that person B wants to buy USD. Person B wants to buy US dollars over here, and for the transaction, the date of transaction is, let us assume it for today itself. Let us take it is a 16th of January 2022. It is 16th of January 2022. Now if the transaction will be settled on the same day itself, if the transaction is going to be settled, that is the funds are going to be settled at both the centers. Now person A is one center, because we are talking about that forex is basically an international market. Forex market is basically related to an international market. Now over there, different parties over there related to be regulators, individuals, corporates, funds over there, investment funds over there. So they all are dealing with the foreign exchange over there. Now when a transaction is initiated at one center, because there are different time zones, and further there are time differences in between, so it will not be the case that the transaction is basically initiated in one center and it will be settled in the same center in the same manner. Okay, but if the settlement of the funds do take place on the same day in both the centers, in that particular case the transaction would be at what rate? At what rate it would be applicable over there? It will be the ready rate, or also said to be the cash rate, which is applicable over there. Okay, so if the transaction settlement date is the same in both the centers, where the buyer and seller are associated in the different territories or in the same territory itself, if it is in the same date, if the settlement is going to be say on the same day, it is said to be the ready or cash rate. Okay, so it is said to be T plus 0 basis. I'm just writing it over here. So it is said to be T plus 0 degrees. T means what it is related with? It is related to settlement of the fund, that is the transaction date itself. So if the transaction is going to be happen on the same day itself, in that case it is said to be on the ready or cash rate over there. Okay, and further, the settlement of the fund is going to be take place on the very next working day. On the very next working day, that is T plus 1 day basis. That is T plus 1 day basis. It is basically based upon TOM rate. It is based upon TOM rate. Okay. And further, if it is T plus 2 basis, that is if the transaction was initiated on 16th of the January, and further the settlement date was not 17th January, but it was on 18th of January. That is T plus 2 days. The transaction was on 16th of January, but the transaction settled 2 days after that particular day. That is basically related to what rate? That would be related to the spot rate. That would be related to the spot rate over here. Is that particular part clear over here? And further, let me tell you that let us take the case that 17th of January is a holiday. Let us take the case the transaction was initiated on 16th of January, but 17th of January it was a holiday in one of the centers. In that particular case, what rate it would be applicable? What rate there would be applicable? Kindly please do answer at the earliest. I just told you that if it is on the same day, it is basically the ready rate or cash rate. If the transaction is going to be settled on the very next day, and that is basically the term rate, that is a term rate will be applicable. And if the transaction is going to be settled T plus 2 days basis, that will be a spot rate would be applicable. But if the 17th of January, that is a date in between, is a holiday in one of the centers, what rate it would be? It would be the term rate. Why term rate? Because I clearly told you that the transaction is settled on the next working day, so it must be working. So the main condition related to selecting the rate over there, it is related to what? It is related to the there must be working day in both the centers. In only then it will be considered. If I say if it was holiday on 17th and both 18th, then the transaction is settled on 19th, still it is going to be term rate. Are you getting this particular point? Okay, so the simple point we understood from over here, that if the transaction is T plus 0 basis, it is cash rate or cash rate or ready rate would be applicable. If it is T plus 1 day basis, it will be the term rate would be applicable. And further, if it is T plus 2 basis, in that particular case, spot rate would be applicable. It is SPOT, spot rate would be applicable in that particular case. Most of the transactions are concluded in spot rate. That is why spot rate is very much dynamic and is very much dynamic and changing all the time over there. Okay, so that is related to the different scenario over there. And one scenario is over there, if the transaction is settled after the spot date, what rate would be applicable? It will be the forward rate that will be applicable. If the transaction was on 16th of January and further it was to be settled 1 month from the date of transaction itself, in that case, what rate would be applicable? It will be the forward rate. So the simple scenario you must understand, if the transaction is going to be settled any day after the spot date, in that case it will be the forward rate which will be applicable over there. Okay, so that is related to the exchange rate mechanism. Now let us have a look at the other aspects of it. So it is related to forward margins, premium or discount. Forward margin, premium or discount. Now how we do calculate the forward rate? Now the simple line over here, it says that the forward rate is calculated from the spot rate itself. So it will be the spot rate and plus or minus the discount, or plus or minus the discount. What is this plus or now what is the premium and what is the discount? So if the currency tomorrow or currency after some time is available at some another price then 2 days price, the currency is not available at par. So if I say today the USD price is 74.57 and further after 1 month it is available at a price of 74.60, in that particular case the currency is available at premium. It simply indicates that the currency is available at premium. Whereas if I say that the currency after some particular period of time it is available at 74.40, in that particular case it basically indicates that the currency is available at discount. The currency is available at discount. Now how we will be finding out that if the currency is available at premium or discount? So there is a rule related to it. Let us consider it. So let me give you a scenario that is related to the 1 USD is equal to 74.63/70. Now you are provided with two-way quotation over here. This is said to be what? This is said to be the two-way quotation. Now what is two-way quotation? In case of two-way quotation, you are provided with the buy rate and the selling rate in the one quote itself. Okay, so whenever I say that 1 USD is equal to 74.63, it's actually a quote that is given to me. It's actually a quote, it is given to me. It may be the buy rate or it may be the selling rate. But when both of the rates are given to you, are basically given to you in single quote, that is said to be two-way quotation. Okay, so over here on the left hand side of the slash, it is the buy rate, and on the right hand side of the slash, it is the selling rate. So I'm writing B over here. That basically indicates that 74.63 is the buy rate and 74.70 is the selling rate over there. So that is related to it, that the buying rate is 74.63 and the selling rate is 74.70 over there. And further, we are provided with the 1 month forward points. We are provided with the 1 month forward points. Let us take the case. These are given to be 30/40. These are given to be 30/40. Now, what are forward points actually? forward points are based upon the interest rate differential. Now there is a new terminology I'm using in each and every sentence over there, but just try to understand it in such manner that it is basically the forward points are related to the interest rate differential over there. Now what is interest rate differential? Let me give you a quick example. Let us take the case that in India the interest rate is 6%. Interest rate is 6%, but in USA the interest rate is 4%. The interest rate is 4%. Now what will be the scenario? Definitely people in USA or people all over the globe will be finding the opportunities so as to invest into the India itself. So they will be doing what? So in USA, what will be the scenario? That they will be selling the USDs. And further they will be purchasing the INR so as to invest the monies into the Indian market itself. Okay. So if the interest rate is higher in one territory and is lower in the other territory, that basically leads to that there will be inflow to that particular territory where interest rates are higher. Okay, so that is the scenario. That is said to be what? That is said to be the interest rate differential. Now 6 minus 4% would be the interest rate differential, and that is how we do calculate that is basically the main funda related to calculation of the forward points. We will be also looking into that particular point, that how we can do calculate the forward points, but try to understand right now that the forward points are related to the interest rate differentials over there, and 1 month forward points are given to be 30 and /40. Now these are the buying points and these are the selling forward points. Okay, now the rule over here that you need to memorize, that is related to if the selling forward points are greater than that of the buying forward points. In that case, it is said to be the currency is available at premium. In that particular case, it is basically concluded that the currency is available at premium. And whereas if the selling points are lesser than that of the buying points, then the currency is said to be available at discount. Currency is said to be available at discount. Now, if the currency is available at premium, the forward points are added up. And if the currency is available at discount, the forward points are subtracted. Okay, the forward points are subtracted. So this is the buying rate and this is the selling rate. Now, if I say what will be the 1 month forward buying rate, should I be adding the forward points to the quoted rate, or should I be subtracting the forward points from the quoted rate? Kindly please do answer at the earliest. I want it to be an interactive session so as to you answer all the questions over there so that I get an idea that you are understanding this particular point or not. Okay. So we have received a mixed response over here. Some are saying that it will be added up, or someone are saying that it will be subtracted. Now I just told you that if the selling forward points are greater than the buying forward points, in that case, the currency is available at premium. And when the currency is available at premium, it is to be added up. Now over here, we have the selling forward points are given to be 40, whereas the buying forward points are 30 over here. So 40 is greater than 30. So it is basically the case related that the currency is available at premium. And if the currency is available at premium, it will be added up. Now what will be the 1 month forward buying rate? So the buying rate over here, it is given to be 74.63. It is 74.63. So 74.63. And what are the buying points after 1 month? These are 30. So as we saw that it is a case related to premium currency, so we will be adding up the 30 points over here. So that will be the answer related to it. So 1 month forward buying rate is 74.93. Is that clear over here? After that, if I say, just do let me know 1 month forward selling rate, what it would be. So kindly please do answer at the earliest. I want you all to participate, and further if you have any doubts, please do ask so that we have no ambiguity related to the concepts over here. Okay, so what will be the answer related to the 1 month forward selling price? I'm just asking for the price over there. Someone has answered related to the forward points. I think they just added up the points, but you need to tell me the answer actually. Okay, so it is basically, what is the selling rate over here? What is the selling rate? Let me write over here. It is 74.70. That is a spot rate that is given to you. So this is a spot rate. No, actually, I just told you that forward rates are calculated on spot rate itself. So the spot rate is given 74.70, and 1 month forward, we just have just looked into the previous case also that the currency is available at premium. When the currency is available at premium, simply add the forward points over here. We'll be adding up the 0.40 forward point because the currency is available at premium. So that would be it. So it will be equal to 75.10. So it will be 75.1 or 75.10. That would be the right answer. That would be the right answer. Okay, so that is related the concept to that how we can do calculate the forward rate. So forward rate is a mix of spot rate, or we will be adding the premium, or we will be subtracting the discount from it. That is the forward rate, at how we calculate. Okay, let's move further. Now this is the formula related to that how we can do calculate the forward points. Now the question can also be asked related to calculation of the forward points. I already told you that the forward points are calculated based upon the interest rate differential. Now what are the main components that how we calculate the forward points? So it is basically depending upon the spot rate, interest rate differential, that is the interest differences between the two currencies in the two territories over there, into the forward period. So for what period you are calculating the forward points, that is also one point now that you must be worrying about. So it is a spot rate multiplied by the interest rate differential multiplied by the forward period divided by the number of days in year, because the forward period over here we must have mentioned it in days, that is why we just divided it by number of days in India, and interest rate differential was in percentage, so we just divided it by 100 so as to convert it into the decimal part over there. So that is a formula related to the forward points over here. You need not to cram, you just need to memorize the thing that the forward points are basically based upon what? These are based upon the forward period, the interest rate differential, and the spot rate. That is it. That is how you can do calculate the forward points. So we'll be solving some of the questions based upon it. Let us have a look at it. So it is given over here, calculate the forward points or the swap cost. Calculate the forward points or the swap cost. Euro 1 is equal to USD 1.60. Interest rate differential is given to be 6%. Forward period is given to be 90 days. And in the example over here, it is said to be clearly that we need to take the number of days to be 360 for easier calculation purposes. Okay. So we will be substituting the values over here. The spot rate is given to be USD 1.60. Multiplied by the interest rate differential, that is given to be 6, multiplied by the forward period, that is given to be 90. So as to converting the percentage into the decimal part divided by 100 and number of days into year, so it will be 360, and it is given in the question that we need to take the number of days in a year to be 360 over here. That is why we just took it as 360, otherwise we will be considering it to be 365. Okay, so just we will be solving it out, and here comes a solution. 1.6 multiplied by 6 multiplied by 90 divided by 360 divided by 100 over there. So 0.024 will be the 0.024 would be the forward points in this particular case. Okay, so this is how we can do calculate the forward points. This was a quick question based upon that. Now let us have a look at the direct and indirect costs, and it's quite important concept you must be understanding. So direct cost is actually related to where the foreign currency is having a fixed unit and the home currency is variable. And home currency is variable. That is a direct cost. That is a direct cost where your foreign currency is having a fixed unit, and further your home currency is having a variable unit. That is basically what? That is a direct cost over here. As it is mentioned over here that USD 1 is equal to INR 76.10. As it is given to be USD 1 is equal to 76.10 INR. That would be basically what? That is basically a direct cost given to you. That is a direct cost given to you. Okay, so over here you are provided with only one cost. You are provided with only one cost, and simply we can say it is a direct cost where the foreign currency will be a fixed unit. It will be the home currency which will be variable. It will be the home currency which will be variable. So as you just see now that today USD is equal to 76.10. Tomorrow it may be the case it will be 74.10 and so on. That is basically related to direct costs we are dealing with. It is basically the direct costs we are dealing with. Indirect costs are now discontinued. Now these are not in use and these are discontinued. What do you mean by indirect cost? Indirect cost is a case where home currency is having a fixed unit and the foreign currency is variable. And the foreign currency is variable. That is related to INR 100 is equal to USD 1.31. INR 100 is equal to USD 1.31. That is basically indirect cost, and these are discontinued. These are discontinued. Over here in the direct cost, it is given that if you want to make a profit, the rule is buy low, sell high. Buy low, sell high. What does it indicate? So if today INR is equal to 76.10, if I just assume that if INR is equal to, if USD is equal to INR 76.10, I'll be purchasing 1 USD in 76.10. I'll be purchasing USD in INR 76.10 over there. And let us suppose that tomorrow the price rises up to 77 rupees, 77 rupees per USD. In that particular case, if I sell the USD, I'll be receiving 77 rupees. That is why the rule over there is related to buy low, sell high. You must be memorizing this rule too. Okay. So this is quite easier one. Direct quote is related to where the home currency is a variable and the foreign currency is having a fixed unit. And secondary, it is related to buy low, sell high in case of direct quote. And for the in the indirect quote, it is related to buy high and sell low. Buy high and sell low. What it is related to? It says we will be getting more units of the USD in rupees 100. So it means buy high where you are getting 1.31 USDs for rupees 100 and sell low when you have to sell. Let us take the case that the USD prices just now have risen up. In that case, let us take a case you have to sell 1.25 USD and you'll be still getting 100 rupees. That is the rule over there so as to make the profit. So it is related to buy high and sell low in case of indirect quote over there. And there is a rule related to that in the case of three currencies. In case of three currencies, let me tell you, it is related to Japanese yen, Kenyan shilling, and Indonesian rupiah. So there are three currencies in which case the price is quoted not for the single unit but 100 of the units. Otherwise, for all the currencies, the price is quoted for single unit of the foreign currency. But in case of Japanese yen, Kenyan shilling, and Indonesian rupiah, it is a case the prices are quoted for 100 units of the foreign currency. The prices are quoted for 100 units of the foreign currency. That is a rule over there. So there are three currencies: Japanese yen, Kenyan shilling, and Indonesian rupiah. Because when the questions are being asked, taking in account these three currencies, you need to calculate the answer as per that particular scenario. Okay. So now let's move further. It is related to cross rate. Now, what is actually cross rate? Now, it may be the case that for single currency pair, you are not able to calculate the prices. Let me tell you with an example over there. Over here, it is given that B wants to remit euro. And further, the two-way quotation is given to be USD 1 is equal to 76.10/25, and further it is given to be USD 1 is equal to euro 1.06. We need to calculate the euro to INR price. Now there is no direct quote. Available for euro to INR, but there are different currency pairs available where USD is common in between. Now USD to INR rate is available and USD to euro rate is available, and you need to calculate the euro to INR price. That is said to be the cross rate or chain rule. This is said to be the cross rate, or we will be using the chain rule so as to calculate the relationship between the euro to INR, the prices we want to calculate for the euro to INR. Now the question is somewhat complex over here, as it says B wants to remit euro. Now when B wants to remit euro, now B is basically, it is not mentioned, it is a bank or something. So it is simply said to be what? It is simply said to be that B wants to remit euro. Now B is an individual over here who wants to remit euro. B is an individual over here who wants to remit euro. When you have to remit euro, you must be purchasing the euro now. First of all, you need to understand this, that if you want to send something, because remitting is related and I want to send money to my friend, okay, or my relatives over there, or maybe for any other purposes, but for that particular purpose, I must be purchasing the euros. Over there. And further, that is related to what rate? That is related to the merchant rate over here. Now here comes another concept that is related to the interbank market rate. And the merchant rate. Now what is interbank market rate? When banks are quoting prices, to the banks, other sets, or the other organization or other financial institution itself, that is basically the interbank market rate. But when the bank is quoting the price to the customer itself, that is a merchant rate. Okay. Now over here, if the person B, let's try to understand this concept thoroughly because it's quite important over here. So if person B over here wants to remit euro and he visited the bank XYZ over here, he wants to remit the euro. Now B wants to purchase, B wants to buy the euro. B wants to buy the euro. Now what price shall be quoted? It shall be the buy rate or the selling rate. Kindly please do answer. It shall be the buy rate or the selling rate that must be quoted to the customer over here. It should be the selling rate. Very right answer, which has been posted by Suraj over here. That is, a selling rate must be quoted. Why selling rate? Because if someone wants to buy something from us, the rate we will be quoting, that will be the rate at which we are ready to sell. At which we are ready to sell. So what rate it is basically? It is a merchant rate that would be applicable. It is a merchant rate that would be applicable. So the scenario over here is that B wants to buy the euro. B wants to buy the euro, but we will be selling him the euros at the rate at which we are ready to sell. At the rate at which we are ready to sell. So you need to take care of that. And further, what is related to interbank market rate? When the banks are dealing with each other, if the XYZ bank is ready to buy, it will be basically quoting the buying rate. And further, when the bank is ready to sell, it will be quoting the selling rate over there. So in that particular case, in the case of the interbank market rate, same rates are quoted, but in the case of the merchant rate, the opposite rates are quoted, and you need to understand the question thoroughly so as to take care of that particular aspect. Okay, so over here it is said to be B wants to remit the euro, and further we are provided with the spot rates over here. So whensoever it is nothing is mentioned in the question is silent about it, that what rate is given over there. In that case, what rate it is? It is a spot rate which is given over there. It is a spot rate which is given over there. So USD 1 is equal to INR 76.10/25. So this is the buy rate, this is the selling rate, and further we are provided that USD 1 is equal to 1.06 euro. So this is a scenario which is given to you. Now what you will be doing actually? That first of all we will be buying the USDs. And after that we will be selling them in the market so as to get the euros. So that is the scenario over there. At what rate we shall be buying the USDs? It shall be the rate at which the market is ready to sell. The market is ready to sell. So it will be USD is equal to 76.25 INR. So it is basically USD is equal to 76.25 INR over there, and further USD is equal to 1.06 euro is given over there. So that is a scenario which is given to you. Okay, so over here you just need to equate these two sides. One USD is equal to this and the other one USD is equal to this. So that actually what it means, it actually means 76.25 INR is equal to 1.06 euro. Okay, now you can definitely calculate the euro to INR rate. It will be 76.25 divided by 1.06, that is euro to INR. Over here. Okay, so that is how you can do calculate. Okay, so that will be the answer over here. So that is equal to 76.25 divided by 1.76.25 divided by 1.06, that is equal to 71.93. I think I just made some mistake. 76.25 divided by 1.06, that is equal to 71.93. Yes, so that would be the answer over here. So 76.25 divided by 1.06, so that would be the answer, that is 71.93 over there. Is that particular part clear over here? So that would be the answer in this particular question. Okay, and this is said to be what? This is said to be the cross rate. So you understood two concepts over here. One, it was related to the interbank market rate and the merchant rates. Let me explain this to you again. So over here it was said that B wants to remit the euro. For that particular purpose, B has to purchase the euros. Now for that particular purpose, we need to buy the USDs first of all. At what rate we will be able to buy? At the rate at which the market is ready to sell. The market is ready to sell at what rate? at the 76.25 it will be ready to sell. So here was the concept related to which was used for the interbank market rate or merchant rate. So now B is not given to be, it's a bank or something like that. If nothing is mentioned, simply we will be taking up the 76.10. So if we consider the another part of it where nothing is mentioned, where the first line is not given and it is given that USD1 is equal to 76.10/25, and for the USD1 to euro rate is given, in that particular scenario, you will be just picking up the value over there that is related to 76.10, that will be buying the price at 76.10 and further will be selling at 1.06. So that would be the scenario applicable over there. But it was given in the question, that B wants to remit the euro. That basically changed the language over there. That basically changed the scenario over there that you need to take care. Okay. Let's move further. So here it is a exercise related to the different rates over here. So you just need to answer that what rate shall be applicable. I'm just numbering them and you need to just answer accordingly that what rate shall be applicable. Okay, so if the date of contract is 29th of September 2020 and the delivery date is the same day, what rate would be applicable? It will be the ready rate or cash rate which will be applicable. Very right. It will be the ready rate or cash rate which will be applicable. And what would be the answer related to the second one over here, where the date of contract is 29th of September 2020 and the delivery date is 30th of September 2020. In that particular case, what rate will be applicable? It will be the TOM rate, because the settlement date is a T plus 1 day and it is already given over here that assuming all days are working in both the countries. Okay, so that is why it will be the TOM rate at which will be applicable. It is T plus 1 day basis. Above over here it was T plus 0 day basis, and over here it is T plus 1 day basis. And if the date of contract is 29th of September 2020 and the delivery date is on 1st of October 2020, what rate would have been available over applicable over there? So it would have been spot rate which is applicable, that is T plus 2 day basis. T plus 2 day basis. And if the date of contract is 29th of September 2020, delivery date is 15th of October 2020, which rate will be applicable? It will be the forward rate which is applicable. I hope that you must have understood the concept related to the settlement dates and further related to that how we can calculate the forward rate from the spot rate and the forward point. Further, we have learned the concept related to the interest rate differential, forward point calculation, and further related to the cross rate mechanism. Let's basically consider the another point over here, that is related to bid and offered rate. Now it is only and only the different names for the same thing. Now the buying rates are also said to be the bid rate. The buying rates are also said to be the bid rates, the rates at which the bank is ready to buy. The rate at which the bank is ready to buy, it is said to be the bid rate, and the rate at which the bank is ready to sell, it is also said to be as the offered rate over there. It is also said to be as the offered rate over there. And further related to the concept of percent and per mil. So percent is basically related to a proportion per 100. If I say 1%, it basically indicates 1 out of 100. Whereas in the case of the per mille, it is related to, if I say 1 per mille, it is basically 1 per 1000. That is the concept, because these are the very, very smaller concept, but the questions definitely can be asked from over here. Now, based upon the value date and the transaction, we actually say the transactions are of two types. First of all, we basically learned about the rates, that what different type of rates are applicable over there, and I just told you that there are voluminous transactions under the spot rate category, because all the forward rates are also based upon the spot rate over there. So based upon the value date itself, there are two type of transaction. One, it is a telegraphic transfer, that is said to be the TT transaction. These are said to be the TT rates, and the other one are the bills rate. Now if the transaction is settling in both the centers on the same day, the TT rates will be applicable. And further, if there is differences between the settlement date, if there is a difference between the settlement date, in that case the bills rate will be applicable. In that particular case, the bills rate will be applicable over there. Further, these are classified to be as the TT selling rate and further TT buying rate and also the bills buying rate and the bills selling rate. Now there are different scenarios where this rate would be applicable, but you must be sticking to the basics only, and further based upon that we will be solving the numericals too. So let's move further and we will be using this concept very shortly. So next it is related to arbitrage in exchange. Now what is arbitrage? Arbitrager is a person who basically exploit the market situation. Basically exploit the market situation. Now you are dealing in different markets. You're dealing in different markets. Let us take the case. I'm dealing in one market in Australia and I'm dealing in another market in USA over there. Now I know the scenarios over there. Now there are time zone differences. In that particular case, also the fluctuations may be there. And at the same time over there, it may be the case that the currencies are available at different prices. So I'm taking the scenario that over here we are having the territory 1 and over here we are having the territory 2. Now the person who's dealing with these two different territory, he basically makes use of his senses and further make use of the environment over there, and further he exploits the market. Okay, so let us take the case that USD is available at premium in one market, and further at the same time it is available at a discount in the other market. It is available at a discount in another market. So definitely at the same time he will be purchasing the USDs from the territory 2 and will be selling them in the territory 1. That is basically related to be that is said to be what? That is said to be arbitrage. So there is simultaneous buying or selling of a commodity in two or more markets so as to take advantage of the temporary discrepancies in the prices itself. That is said to be what? That is said to be arbitrage in exchange. Okay, so that is said to be what? That is said to be the arbitrage in exchange. Now let's move further. So it's related to the, we'll be just moving to the numerical part over here first of all. So it says problem on TT buying rate. So we'll be covering the different rates over here and I'll be making you understand where these different rates are used. So it says bank XYZ received a money transfer of USD 10,000 already credited in the Nostro account. Now you must be understanding the particular lines over here. First of all, it says what? Bank XYZ received a money transfer. So there is a case that person B, who is a customer of yours, just visited the branch, just given you a money transfer over there, and further the money transfer in the name of person B was received in the Nostro account. Now what is Nostro account? Let me tell you the scenario that XYZ bank over here is dealing in India, and so as to basically operate in the other territories, whether they will be having their branches overseas or they can also operate through their correspondent banks. They can also perform their activities over in the other territories through the correspondent banks over there. Now let us consider that ABC bank is over there in USA. And XYZ over here is in India. Now ABC bank over here is a correspondent bank of the XYZ. Now XYZ bank will be maintaining a foreign currency account in the bank ABC over there. Now this currency account is basically foreign currency account and it is basically being maintained in USD over here. This account will be Nostro account. This account will be the Nostro account of the bank XYZ. Okay, so that is basically the account that the bank is maintaining with the correspondent bank over there, and this is being maintained in the foreign currency over there. So the question, now kindly please read the first line again. So it says bank XYZ received a money transfer of USD 10,000. Now USD 10,000 money transfer was received in the name of person B, which is already credited in the Nostro account. Now the account is already credited. Now I just told you, now if this particular line over here, it is not written at problem on TT buying rate. I just already told you that in the case of the TT rates, the transaction is already settled. Or it is a case that the transaction is settling on the same day itself. Okay, so that is where the TT rates would be applicable. Okay, so now over here, the transaction is already settled. That we will be quoting the customer at the present rate. We will be quoting the customer at the present spot rates over there. So that is a concept related to what? That is a concept related to the TT rates. Now how we will be making sure that what price would be applicable? Now the first scenario that we understood that the TT rates would be applicable. that the TT rates would be applicable because the amount is already credited. Now the amount is already credited. Now this amount belongs to person B. Now just take care of that particular thing, that this particular amount of 10,000 USD, it belongs to person B, which was credited to the Nostro account of the bank XYZ over here. And further, what amount will be paid to the customer? Now look from the bank perspective over here. B wants to sell these 10,000 USDs. B wants to sell these 10,000 USDs. Now what rate shall be quoted? It will be the buying rate or will be the selling rate that shall be quoted. What rate is applicable over here? It is a merchant rate which is applicable because you are going to deal with the customer over here. So it is a merchant rate which is applicable over here. Now B wants to sell the USDs. What rate will be quoting? We will be quoting the buying rate over here. We will be quoting the buying rate over here. Now already we have seen that it was a TT rate which was applicable, and which rate is to be quoted? It is a buying rate is to be quoted over here. So what rate is will quoted over here? We'll be basically discovering the price using what formula? We'll be discovering the price using the TT buying rate formula. We'll be discovering it using the TT buying rate formula. Now what is the TT buying rate formula? Because the transaction is basically on the same date itself, because it's already there, we'll be basically calculating the transaction on the spot rate itself. So there will be no forward differential will be used. No forward differential is used in any TT rates. Okay, so it will be the buying rate which is applicable. So it will be the spot rate. It is a spot rate. And further, let me just tell you that you need to memorize that when it is a case of the buying rates, whether it is a bills buying rate or it is a case of the TT buying rate, the margin is to be subtracted. The exchange margin, if given, is to be subtracted. So spot rate minus the exchange margin. Minus the exchange margin. Is that clear? So spot rate minus the exchange margin, it is to be subtracted over there. Now what rate shall be quoted? Now the price is given to be, spot rate is given to be 76.30 slash 45. Now 1 USD is equal to INR 76.30, which is the buying rate, and 76.45, that is a selling rate over there. Now we will be considering the buying rate over here. So 76.30 minus the exchange margin. Now exchange margin is 0.10%. Exchange margin is 0.10%. So it will be equal to 76.30 minus 0.1% over there, and that is equal to 76.2237. Now what amount is to be credited? Multiplied by 10,000 USDs. Now the question was what amount will be paid to the customer. So what amount will be paid to the customer? 76.2237 multiplied by 10,000, because 10,000 USDs were credited in the Nostro account now. So it is 762237. That is the amount which will be credited to the customer's account. Is that clear? Is that particular part clear over here? Okay. So that is the answer related to this particular question. Okay. Now let's move further to the another question. It says problem on bills buying rate. Problem on bills buying rate. It says on 26th March 2020, your customer has presented to you their bill of USD 50,000 drawn on party in USA. Request you to purchase the same. Request you to purchase the same. Spot rate is given, 1 month forward rate is given, transit period is given to be 20 days, and exchange margin is 0.15%. Okay, and transit period is to be rounded off to the higher month. It is to be rounded off to the higher month. Okay, now you are already aware of the concept related to the letter of credit. You are already aware of the concept related to the letter of credit, and you must have all read about the concept related to the bill of exchange over there. Now what is bill of exchange? Let me give a scenario over here. Over here we are having an exporter and person I is an importer, that is buyer of goods. Now if the person just bought some goods, person just bought the goods but has not paid the amount yet, now exporter will be doing what? Exporter will be drawing a bill. Exporter will be drawing a bill. So exporter will be the drawer of the bill. Exporter will be the drawer of the bill, and exporter will be drawing a bill on person I over here. Person I has to accept that bill. And further, after acceptance, this bill will be given back to person A. Okay, this bill will be given back to person E over here. That is said to be the export bill over here. That is said to be the export bill over here. Is that clear? Now what is export bill? Export bill is that bill which was basically drawn by the exporter itself and was accepted by the buyer or the buyer's bank itself. Or the buyer's bank itself. That is the case over there. Now this bill was received by person E again. Now person E went to the bank over there. Now person E went to the bank XYZ because he basically needs liquidity. Now person I says that I'll pay this bill on demand. That I'll pay this bill on demand, but you are not in same territory. And definitely it's going to take some time. And that particular time, when the exporter has made the shipment and the date till it is credited to the nostro account of the XYZ bank, because XYZ bank is dealing in the overseas functionaries through the bank ABC, which is correspondent bank of the bank XYZ, and XYZ bank is basically has maintaining a nostro account over there. XYZ bank is basically maintaining a nostro account over there. Now even if bill is being sent for collection, in that particular case, what is going to happen? Definitely it will take time now, because when the bill will be given to XYZ bank will be forwarding it to the correspondent bank will be going to the buyer itself or to the buyer's bank where it will be presented, and then the buyer will be making the payment, and then it will be credited to the nostro account of the bank XYZ over here. So that is going to be the scenario. And that particular time period which is going to take place over there, that is given to be 20 days. Now 20 days is given to be transit period. Transit period is basically not related to the period that when the goods will reach to the customer over here. That is not that particular period. Transit period over here, it relates with the period when the bill will be presented, how much time it's gonna take. So it is basically 20 days it is given to be. So this much time it will take so as to get the bill cleared and the amount be credited to the nostro account of the XYZ bank over here. Okay. Now the XYZ bank just purchased the bill related to exporter, and further the bank is to credit the amount to the exporter's account. Credit the amount to the exporter account, but the bank will be receiving the amount now only or after 20 days. Definitely, I just told you that it is going to take time. So definitely the bank is not going to receive the amount right now. So just keep that particular thing in mind, that the amount is not settled. So what rate would be applicable? It will be the bills rate which will be applicable. Because the amount is yet not settled over there. Okay. And further, it will be the buying rate or the selling rate. Because the exporter, when the amount will be received, the exporter wants to sell the foreign currency. Let us take the case, it is basically having 50,000 USDs. It's involving 50,000 USD. So exporter wants to sell 50,000 USDs to the bank over there. So what rate shall be applicable? Because exporter wants to sell, and the exporter will be able to sell at a price at which the bank is ready to buy. The exporter will be able to sell the bill at a price will be able to sell the foreign currency at a price at which the bank is ready to buy. So what rate shall be quoted? It will be the buy rate which shall be quoted. So it is basically related to what? It is basically related to the bills buying rate. And further, it is given that transit period is to be rounded up to the higher month. So it is basically given to be for 20 months, and further it is rounded off to the higher month. So we will be considering it for the 1 month. And 1 month forward rates are provided over here. So how we will be discovering the price related to the bills buy rate? Here is the formula that you need to memorize. That is bills buying rate. It is equal to spot rate plus minus premium or discount. And further, as I already told you, that if it is a buying rate, the exchange margin is to be subtracted. So over here it is related to that the exchange margin is to be subtracted. Okay. So this is how we will be calculating the price. So the spot rate is given to be what? This is the buying rate and this is the selling rate. And we are concerned about the buying rate. So it is 72.30. Now we need to check if the currency is available at premium or discount. Now 1 month forward points are given to be 0.40/50. Now the selling forward points are greater than the buying forward points. Now the currency is available at what? Currency is available at premium. Very right. The currency is available at premium. When the currency is available at premium, we do add the points or subtract the points. We do add the point. So we will be adding up the forward points. What forward points? Buying forward points only. So it will be 0.40 to be added up. 2.40 we will be adding up, and further it will be equal to 72.70 minus the exchange margin, which is 0.15%. 0.15%. So it is 72.70 minus 0.15%, that is equal to 72.59095. 72.95095. So that would be the price that would be applicable on the transaction, as per which we will be crediting the amount to the customer's account over there. So that will be the answer related to it. So that comes out to be 72.59. Very right answer has been given by Suraj over there. Okay, let me explain to you this again, that how we just from the wording over here, because it will not be given to you in the question itself that it is related to the buying rate or bills rate or selling rate or the TT rate. Okay, so how we just concluded, because the bill was basically given to the bank over there for the collection purposes. Now it will definitely take time now, because the amount is not credited. So basically make sure that bills rate is applicable. Now the customer wants to sell the USDs, the customer wants to sell the foreign currency. Now if they want to sell the foreign currency, they will be able to sell the foreign currency to us at what price? At the rate which we are ready to buy, at a price at which we are ready to buy. So it will be the bills buying rate which will be applicable over there, and it's just a single minute question that you can solve it. Okay, because I just wanted to make you understand that how this all work, what should be the thinking process. Okay, so that is related to it, this particular question. Let's move further. It is based on TT selling rate. Now it says an importer has requested you to issue a demand draft on USA for USD 50,000. Okay. Now here is the scenario. Person B, a customer of yours, visited the branch XYZ bank over here, and further he asks that he wants to issue a demand draft in USA. So now you are maintaining your Nostro account with the bank PQR over here in USA, where you are having a Nostro account, and further definitely it will not going to take time now. So when the customer will be asking that he wants to issue demand draft, he will be purchasing the foreign currency, and further will be issuing the demand draft to him. That is going to be the scenario. So what rate shall be applicable? Because there will be no differences between the settlement date over there, because there is going to be no differences between the settlement date over here. So that what basically rate will be applicable? It will be the TT rate simply. TT rate will be applicable, because we do not have to send any bill for the collection. It will not take time. So the bank will be issuing the demand draft straight after basically receiving the amount. Okay. So what rate will be applicable? TT rate will be applicable. And customer B wants to buy the foreign currency. Customer B wants to buy the foreign currency. At what rate the bank, B will be able to buy the foreign currency? At a price at which the bank is ready to sell. So if B wants to buy the foreign currency, because he wants to issue a demand draft in USD, for that particular purpose, he needs to purchase the foreign currency. So at what price he will be able to buy the foreign currency? At a price at which the bank is ready to sell. At a price at which the bank is ready to sell. Now the bank is ready to sell at what price? At the selling price itself. Now, so it will be the TT selling rate which will be applicable. TT selling rate which will be applicable. Now the spot rate is given to be 1 USD is equal to 76.32/48. So this is the buying rate, this is the selling rate. What rate will be considering? We'll be considering 76.48. Further, I just told you that the exchange margin is subtracted in the case of the bills rate, but is added up in the case of the selling rate itself. Okay, it's added up in the case of the selling rate over here. So exchange margin is given to be 0.15%. So it will be simply added up. So what is the formula related to the TT selling rate? It is equal to spot rate plus the exchange margin. Okay, so that is related to it. So that would be the answer over here. So that is the answer over here. So what is the amount which is payable by the customer? 76.48, and further it is plus 0.15% multiplied by 50,000. So that is the amount which is payable by the customer. That is 3829736. 3829736. That particular amount is payable by the customer over there, so as to bank to issue the demand draft amounting 50,000 USDs. Okay. I hope that you must have understood the concept related to this particular question. Now let's solve one another question based upon that. So it is problem on bills selling rate. Problem on bills selling rate. Now this is somewhat complex but not difficult. You must be understanding the wording that why the TT selling exchange margin is added up over there. Okay. So first of all, it says on 26 March 2020, importer has received an import bill of USD 50,000. He asks for retirement of the bill. Now what is the retirement of bill? It's not like what is actually import bill. Import bill is basically a bill which was accepted by you, and further you need to pay off the amount. Now, which I just told you related to the bill scenario over there, where E is the exporter, I is the importer, I is the buyer over here, I is the buyer over here, and for the exporter just has shipped the goods, but the importer has not paid the amount yet. In that particular case, a bill was drawn by the exporter over there. A bill was drawn by the exporter over there, and further it is drawn on importer, and the bill was got accepted by the importer, and further the bill is now received by the exporter over here. That will be basically concluded it is an export bill. That we basically concluded that it was an export bill. Now I is having the obligation. I is having the obligation, is having the liability, so as to pay back that particular bill. So as to pay back that particular bill. Now let me give you an example that if the bill was drawn, if the bill was a side bill. Now there can be two types of bills. One it is the side bill, and the other it can be the usance bill. Other bill it can be the usance bill. Now what is the side bill? Which is to be paid on presentation of the bill. So whensoever the bill will be presented by the exporter over here, the amount is to be paid by the importer. The amount is to be paid by the importer. And what is the second type of the bill? It is a usance bill. Now what is a usance bill? In the case of the usance bill, the amount is to be paid back after some particular period of time. So it may be the case that the usance period, if it is given in the question, it may be the case that the usance period is given to be 2 months, 1 month, 3 months, or 6 months. Okay. So whatsoever the credit period is basically extended by the exporter over here, that is basically the usance period over there. Or it may be the case that a particular due date is mentioned. A particular fixed due date is mentioned over there. So that is also said to be what? That is also said to be the usance bill over there. But if it is not the case, that if no credit period is given, if no fixed date is mentioned over there in the bill itself, in that case, it is basically the side bill. It is the case of the side bill over there. Okay. Now importer at its own end, before the presentation of the bill by the exporter itself, wants to pay the amount. That is basically said to be retirement of the import bill. That is basically said to be what? That is said to be the retirement of the import bill. So retirement of the bill is, or import bill, is basically no other bill but the bill, that the export bill that the buyer wants to pay off. Okay. So that is basically the concept related to retirement of bill that you must be understanding. Further, it is given to be the spot rate is given, 1 month forward rate is given over there. And it is mentioned that exchange margin on TT selling rate is 0.15%, and exchange margin on bills selling rate is given to be 0.20%. It is given to be 0.20%. Now what will be the scenario? Now the importer wants to pay off the amount to the exporter over there. So importer visited the bank. Importer visited his bank. Let us take the case XYZ bank over here, and further said that he wants to pay off the liability. He wants to pay off the liability. Now for that particular purpose, because the bill was drawn in USDs, the bill was drawn in USDs. So in that particular case, the amount is to be paid in USD only. The amount is to be paid by the importer in USD only. Okay, is that simple? And further, now if importer wants to pay the amount in USD, he needs to buy the USD. First of all, he has to buy the USD over here. Now at what price he will be able to buy? Because he is a customer over there. Bank is a merchant over there. Merchant rate, bank is an institution who is going to sell. So the merchant rate would be applicable. So that the merchant rate would be applicable. So I would be able to buy the USD at a price at which the bank is ready to sell. At which the price the bank is ready to sell. So what rate shall be quoted? It will be the selling rate which will be quoted. It will be the selling rate which will be quoted. But when the rate is quoted, just think of a point that there is no settlement difference when the XYZ will be issuing the USDs to the importer over there. Same as the scenario when in the previous case the demand draft was to be issued by the bank itself, and the customer demanded, so as for the issuing of the demand draft, the customer was to buy the USD. In that particular scenario also, the customer was to buy the USD, and further the bank just issued the USDs to the customer over there. So that case scenario, particular scenario is also applicable over there, because buyer wants to buy the USD and XYZ bank over here will be instantaneously issuing the USD. So there will be no difference. So what margin would be applicable to that particular transaction? Now over here, this particular transaction, I'm just highlighting, it is a TT selling rate transaction. It is basically the TT selling rate transaction. Is that particular part clear over here? Because over here there is no lag, there is no difference between the settlement date. So TT selling rate would be applicable over here. So TT selling rate would be applicable over here. And what was the formula related to it? It was related to spot rate. And further, in the case of the selling rates, the exchange margin is to be added up. Exchange margin is to be added. And what exchange margin will be added up? Over here, it will be the TT exchange margin. It will be the TT exchange margin which will be added up. Now, once the bank has issued the USDs to the customer over here, the transaction is yet not completed. The transaction is yet not completed. Now, XYZ bank through the correspondent bank, will be retiring the bill, and definitely that's going to take some time. Over there. That is why it is said to be what? It is the bills selling rate. It is said to be the bills selling rate which is applicable for the transaction, and for that particular purpose, the exchange margin for the bills rate, the bills selling exchange margin, that will be added up. Exchange margin for the bills rate would be applicable because this particular period lag is over there. For that particular purpose, the bank will ask for the margin. So that is why the exchange margin for that particular rate will also be applicable over there. So that is why in case of the bills selling rate, two margins are added up. The TT selling exchange margin and the bills selling exchange margins are added up. Now what will be the answer over here? What will be the answer in this particular case? It is a spot rate. Now the spot rate is 72.30/40. This is a buying rate. This is a selling rate. This is the buying rate and this is the selling rate. And further, it is related to the bills selling rate. So we are concerned about 72.40. 72.40. Should we be considering 1 month forward rate over here? No, that shall not be considered because we just sold the USDs to the customer at the current spot rate. Now that is why the TT selling rate was applicable. So 1 month forward rate would not be applicable. So 72.40 plus the exchange margin, that is given to be TT selling margin, that is 0.15%. 0.15%. Now here is one part that you need to understand, that you need not to it is not the case that you will be calculating 0.15% and further 0.20% at 0.35%. Okay, so it should not be combined up. So these two terms are not to be combined up. First of all, we will be solving this particular transaction, that is spot rate plus exchange margin related to TT transaction. So 72.40 plus 0.15%, then we'll be adding up the bills selling exchange margin, that is 0.20%. So that is how we will be solving this. Otherwise, you'll be getting a wrong answer. Okay. So it is 72.40 plus 0.15%. 72.40 plus 0.15%. That comes out to be 72.5086 plus 0.20% plus 0.2%. That comes out to be 72.6536. So that particular price will be quoted to the customer. That particular price will be quoted to the customer over there. Is that particular part clear over here? I know this is somewhat seems to be complex, but this is not the case. You must be just sticking to the basics over there, and it's quite simpler so as to understand the concepts related to the foreign exchange. So for this particular lecture, we basically learned the concepts related to foreign exchange applicability, foreign exchange markets, spot rates, and the different scenarios over there. Further, the chain rule, cross rate mechanism, calculation of the forward rate, and further different types of the rates applicable. Okay,